There's a guy named Conrad, 43 years old, thoughtful, reads the financial news, considers himself more informed than the average person about money. Conrad has $74,000 sitting in a high-yield savings account that he has been planning to invest for approximately 19 months. He is not afraid of investing. He is not philosophically opposed to the market. Conrad is waiting. He watched the market climb through 2023, thought it looked expensive. He watched it climb further in 2024, thought a correction was overdue. He watched it move in 2025, thought geopolitical uncertainty made the timing wrong. Conrad has a reason for every month he is not invested, and every reason sounds intelligent when he explains it to himself. Conrad is also, over those 19 months, down approximately $18,000 in returns he did not earn, net of the savings account interest he did collect. He cannot see that loss anywhere on a statement. It does not appear as a negative number. It simply does not exist. A fortune quietly not built while Conrad waited for conditions he could feel comfortable with. Conrad is not an outlier. He is the dominant behavior pattern among financially literate people who have not yet invested. And the cost of that pattern, run to retirement, is one of the most underreported catastrophes in personal finance. Here is what I want to walk through today. Market timing, the practice of holding cash and waiting for a better entry point, feels like prudence. It is mathematically almost indistinguishable from delay, which we already know is the most expensive financial behavior most people engage in. I'm going to show you what the data actually says about market timing versus time in market. I'm going to show you the specific cost of missing even a handful of the market's best days, and I'm going to give you the framework that removes the timing decision from the equation entirely, not because market conditions do not matter, but because your ability to predict them is approximately zero, and the cost of being wrong while waiting is asymmetric in a direction that always hurts you. Start with a historical parallel that makes the structure of this problem clear. In the 1840s, a disease called cholera swept through European cities repeatedly. The medical establishment had a theory. Cholera was caused by bad air, miasma rising from filth and decay. It was a coherent theory. It fit the observable facts. Cholera did cluster around dirty areas. Physicians made decisions based on it. Cities spent resources on ventilation and odor control. In 1854, a physician named John Snow mapped a cholera outbreak in London and demonstrated it was transmitted through contaminated water, not air. The miasma theory was wrong, but it was wrong in a way that felt right because it was built from real observations assembled into a false causal framework. The physicians were not stupid. They were reasoning from visible evidence toward an invisible mechanism they had not yet identified. Market timers do the same thing. The evidence is real. Valuations are elevated, geopolitical risk exists, the yield curve has done something historically associated with recessions. The reasoning sounds right. The causal framework that this visible evidence predicts a near-term correction severe enough to justify sitting out is almost never correct. The market does not behave on a schedule that accommodates your research. Here is the data that destroys the market timing argument with precision. A J.P. Morgan analysis of the S&P 500 over the 20-year period from 2003 to 2022 showed that a fully invested investor turned $10,000 into approximately $64,000. An investor who missed just the 10 best trading days over that entire 20-year period ended with approximately $29,000. Missed the 20 best days? $16,000. Missed the 30 best days? $10,000. Effectively flat. 20 years in the market and missing 30 days out of roughly 5,000 trading days produces a near zero real return. Here's the critical fact that makes this relevant to Conrad. 6 of the 10 best days in that period occurred within 2 weeks of the 10 worst days. The best days cluster around the worst days. The investor waiting in cash for conditions to stabilize, waiting for the crash to bottom out, waiting for clarity before re-entering, is structurally positioned to miss the recovery days that do most of the work. You do not get to wait out the volatility and then catch the rebound. The rebound is the volatility. The days that build the most wealth are the days that feel the most dangerous to be in the market. This is not a theory, it is the return data of every major market cycle since the index has existed. Now add the compounding cost specific to Conrad's situation. He has $74,000 in cash. The 19 months he has waited, the S&P 500 has returned, depending on the specific window, somewhere between 15 and 28% cumulatively. Take a conservative middle figure of 18% over 19 months. Conrad's $74,000, invested 19 months ago, would be approximately $87,300 today. Instead, he has roughly $76,500 after high-yield savings interest. The visible opportunity cost is approximately $10,800. But Conrad is 43. He retires at 65. That $10,800 gap, compounded at 7% over 22 years, becomes approximately $46,000 in retirement wealth forfeited. Not $10,800, $46,000. Every month of delay is not a month of missed return. It is the compounded future value of that missed return, paid silently decades from now from a retirement account that will be smaller than it would have been. Conrad's caution is not free. It has a precise price. He just cannot see the invoice. Here is why intelligent people fall into this trap more reliably than less financially informed people. It is called the illusion of control, and it is specifically activated by knowledge. The more Conrad knows about valuations, economic cycles, yield spreads, and historical crash patterns, the more he believes his pattern recognition is meaningful, that his ability to identify elevated risk translates into an ability to time the response to that risk. It does not. Knowing that the market looks expensive is not the same as knowing when it will correct, by how much, or how quickly it will recover. Every correction in market history was preceded by a period where informed people correctly identified that valuations were elevated. Almost none of them correctly predicted the timing of the correction within a window short enough to make sitting in cash worthwhile. And all of them who sat in cash paid the opportunity cost of the time they waited, regardless of whether the correction eventually arrived. The knowledge is real. The control that implies is an illusion, and the illusion is more convincing the more you know, because you can always construct a coherent narrative from real data that supports waiting just a little longer. So, what does Conrad actually do? 3 decisions. Decision 1. Invest the lump sum now, in full, and understand why the data supports this. Vanguard studied this question directly using 68 years of global market data across multiple countries. They compared lump sum investing, putting the full amount in immediately, versus dollar cost averaging over 12 months. In approximately 68% of historical cases, lump sum investing outperformed dollar cost averaging over the subsequent 12 months. The reason is mechanically simple. Markets go up more often than they go down. In any given year, the probability of positive returns is historically around 74%. Keeping money in cash while the market advances means paying an opportunity cost for every month of delay. The average investor expects this number to be closer to 50-50, which is why dollar cost averaging feels like risk management. It is actually, in most historical windows, a performance drag. Conrad's $74,000 should be invested in a single transaction into a diversified index fund today. Not next month, not after the Fed meeting, today. Decision 2. If the lump sum feels psychologically impossible, and for some people it genuinely does, implement a compressed dollar cost averaging schedule of no more than 3 months. Not 12 months, not 6 months, 3 months. $24,700 per month for 3 months. This is not optimal mathematically, but it is executable for people whose loss aversion makes the single transaction feel unbearable. The explicit rule here is that the schedule is set in advance, automatic, and not subject to revision based on what the market does during the 3 months. If the market drops 10% in month 1, month 2's purchase happens on schedule. If it rises 8%, month 3's purchase happens on schedule. The point of the compressed schedule is to remove the decision from the emotional moment. A pre-committed automatic schedule made by a Conrad who ran the math overrides the Conrad who reads a concerning headline the night before the transfer. That is the version of Conrad who should be making financial decisions. Decision 3. Build a written investment policy statement before you invest and refer to it every time the urge to time emerges. An investment policy statement is a one-page document that answers 4 questions. What am I investing for and on what timeline? What is my target asset allocation and why? What conditions would justify changing that allocation? Under what specific predefined circumstances would I move to cash? The conditions in answer 4 should be precise and verifiable, not when things look risky, which is always, but something like, my income disappears and I need funds within 6 months, or I am within 3 years of needing this money for a specific purpose. If current market conditions do not meet the specific written criteria, the policy answer is to stay invested. The policy statement converts the market timing decision from an ongoing emotional negotiation into a one-time intellectual exercise. Conrad ran the analysis. Conrad made the rules. Present-day Conrad, reading a concerning inflation report at 11 p.m., does not get to override the decision his more rational self already made with full information. This is not rigidity. It is the specific structural defense against the psychological mechanism that is costing Conrad $46,000. Here is the final framing that ties all of this together. There are 2 types of risk in investing. The risk of being in the market, volatility, drawdowns, the possibility that your balance is lower next month than it is today, and the risk of being out of the market, the certainty that you are not compounding, the asymmetric exposure to missing recovery days, the silent and permanent cost of delay that shows up only at retirement when the account balance is smaller than it should have been. The financial media covers the first risk obsessively. Every correction generates headlines. Every elevated valuation generates analysis. The second risk, the cost of sitting out, generates almost no coverage because it is invisible, gradual, and does not happen on a single dramatic day that produces a chart worth publishing. But the second risk is larger for most long-term investors than the first. A 30% market correction recovers in 2 to 4 years historically. The compounding years Conrad forfeited while waiting for that correction do not recover, ever. Conrad is not a bad investor. He's a thoughtful person applying reasonable logic to a problem where reasonable logic produces systematically wrong conclusions. Because the market is specifically not a system that rewards pattern recognition and waiting for optimal conditions. It rewards presence. It rewards duration. It rewards the investor who was in the account, in the index, not doing anything interesting, while Conrad was reading analysis and waiting for clarity that the market is structurally incapable of providing before the fact. The best time to invest was 19 months ago. The second best time is tonight. Subscribe if this reframed what waiting for the right time actually costs. Drop a comment with how long you have been holding cash you intended to invest and run that number through a 7% annual return for your remaining working years. That is the real price of the wait. Most people have never seen it written down. Now you can.